Let us understand what is average due date. For that, let's take a small example. Let's say Mr. A is selling goods on credit to Mr. B, and this happens on various dates. If Mr. B is going to take time to make payment to Mr. A, that is, if he is going to delay the payment, then for delayed payment, Mr. A is entitled to receive interest. Similarly, if Mr. B is going to make early payment, then he is entitled to what is known as interest rebate. Now, both should be understood from the context of the credit period. A is selling goods on credit to B. Let's say the credit period is 1 month. If B is making payment before 1 month, then he is entitled to a rebate. If B is making a payment after 1 month, then A is entitled to interest. But the transactions are happening in various dates. So, these two parties, instead of this kind of arrangement, they want to agree for a common date such that neither party will lose the interest. And that common date is nothing but average due date. So, understand, average due date is the date on which net amount is settled without causing any loss to the person who had given the money, that is lender or can be creditor, and the borrower or can be debtor. So when we'll be using average due date? It will be used when the amount is lent in various installments, but the repayment is going to happen in single installment. Okay, in various dates the amount or the credit were given, but the repayment is going to happen in a single date. So that date should be selected in such a way that neither party loses interest.